Does Social Security need saving? Providing for retirees throughout the 21st century. By Dimitri Papadimitriou and Randall Wray. Investment in stocks, intra and intergenerational redistribution, and money's worth estimates. There are many other issues related to Social Security that are being debated, most of which fall outside the purview of this brief. Complete privatization has been proposed. It is claimed that through individuals' investment of retirement funds in the stock market, privatization could contribute to increasing the long-run growth rate, thereby reducing the burden placed on future generations. It has also been argued that even if burdens on future generations are not reduced, privatization is still desirable. However, we believe that the objections that have been raised overwhelm any possible benefits of privatization. For example, if benefits are closely tied to stock market performance, workers who happen to reach retirement age when the market is low will suffer from low benefits throughout their retirement. Some reform proposals would invest part of the trust funds in the stock market. Many valid objections have been raised against this plan, including the argument that projections of high stock market returns are wildly optimistic. Baker 1998, Cadet 1997, Ball et al. 1997, the Advisory Council on Social Security 1997A and 1997B. In addition, it is clear that Americans prefer to retain Social Security as a public program. We would add that if public investment in the stock market is such a great idea, then why doesn't the Treasury play the investment game to its advantage, issuing debt to the public at a low interest rate and taking positions in the stock market to earn high returns? Why limit the government's involvement to Social Security trust funds? Indeed, unless the government does something like this, the stock market may be doomed to poor returns as the baby boom retirement leads to sales of stocks, both by private funds and by a partially privatized Social Security. However, no matter what the possible returns, our analysis above indicates that the thinking behind proposals for public investment in stocks is flawed. No matter how large the trust funds, they cannot directly ease the burden of providing for future retirees, nor can they directly increase the share of distribution going to retirees. Those who argue that stock returns will be higher than the return on Treasury debt simply have not come to terms with the nature of the future burden. Tax hikes will be necessary in the future if trustee projections concerning economic growth and demographics prove correct. Other analyses are concerned with intra-generational redistribution. They look at Social Security as if it were a pension plan, calculating each cohort's amount of contributions and return on contributions, that is, expected benefits. Not surprisingly, the rate of return varies greatly by income class and by retirement date. Earners with low income generally get a much better return on their investment than do earners with income close to the contribution base. This represents a redistribution within a generation. Social Security has always had a significant redistribution component. Indeed, many of those who receive OASDI benefits never paid into the program directly. On the other hand, by setting a contribution base and by eschewing means testing for most benefits, payroll taxes are not progressive, and benefits are widely distributed across income classes. We do not intend to examine this issue in more detail. Arguments that would preserve intragenerational redistribution can be found in reports of the Advisory Council, 1997A, 1997B. Intergenerational equity and money's worth estimates deserve more attention. We agree with Ball et al. 1997 that ensuring that each generation obtains a good return on its contributions should not be a high priority. We do not even believe that this is an attainable goal, given the changes in demographic patterns. The first Social Security retirees obtained high returns on their investment because of highly favorable demographics. There was a relatively small elderly population, but a large and rapidly growing working-age population and a well-performing economy that ensured high wage growth. As a result, low payroll taxes generated sufficient income to meet benefits. This result will be obtained in any economy with these demographics. In a sense, the pattern of return is similar to a Ponzi finance or pyramid scheme, with returns that are high for the early entrants, but unsustainable for later entrants because the base cannot continue to expand as rapidly as time passes. All mature societies face a similar problem. Generous living standards and rising status of women contribute to lower fertility rates and lower death rates, which lower population growth and increase the proportion of elderly. The burden of supporting the elderly has to rise in such a society. However, money's worth estimates then come into play. Against the cost of supporting the elderly must be weighed the advantages of slow population growth. Fewer resources have to be devoted to increasing the stock of housing, schools, roads, government buildings, and so on, partially offset by the need to increase the stock of hospitals and long-term care facilities. Social unrest and crime tend to fall, and the pace of environmental degradation can slow. When money's worth is viewed in this broader context, it becomes clear that slow population growth creates problems, but also comes in concert with substantial benefits.